Hey guys, today we're going to be looking at Neutrl, which is one of the fastest growing and most exciting yield-bearing stablecoins in the market today that is generating really good yield. We're talking about almost double-digit yield. So we'll be looking at what Neutrl is, how it works, and why it's so damn exciting. Let's get right into it. So Neutrl works very similarly to many of the yield-bearing stablecoins in the market today. So it's pretty much like a tokenized hedge fund. So an interaction with Neutrl will be something like this. You would deposit USDC or USDT into Neutrl, and you would receive its synthetic dollar, which is NUSD. So this is just a stablecoin, and you would then go on to stake this to receive staked NUSD, which is the yield-bearing stablecoin and which gives you the yield, right? So where is this yield coming from? So the team behind Neutrl would take this capital that you deposited and basically run different strategies. So a decent portion of this capital that you deposited is put into other yield-bearing stablecoins. So these yield-bearing stablecoins would be earning a base yield, all right? And Neutrl also does delta neutral basis trading. But the most interesting strategy, and where most of the returns and most of the yield comes from for stakers of NUSD, is something called the OTC arbitrage. And this strategy is what is the flagship of Neutrl, and it's what allows Neutrl to generate really, really good yield for stakers of NUSD. So today we'll just be covering the OTC arbitrage strategy that Neutrl is doing. So what does OTC arbitrage really mean? I know it might sound a little confusing, but trust me, it's very simple. The idea is very simple, and once you understand it, you can really understand how genius the strategy is, all right? So we all know it, like tokens launch every day in the market, right? And let's suppose there is this project X that launches a token X. And when it launches a token X, teams, foundations, VCs, advisors, all receive the token X, right? But the thing is, their tokens are locked, meaning they can't immediately go and sell it and do whatever they want to do with it, right? So they would have to wait maybe 6 months, 1 year, or even 2 years, right? So they have to wait for the unlock to sell it or do whatever they want to do with it, right? So there is a problem here, right? So these guys, these entities are holding on to like millions, tens of millions of dollars worth of locked X token, right? But they sometimes really need liquidity. They really need cash. They don't want to wait 6 months, 1 year, or 2 years to kind of sell the token and get capital, right? They sometimes really need cash urgently, right? So this could be in the form of foundations that are very token rich, like they have a lot of locked tokens, like tens of millions of dollars, but maybe they are very poor in terms of capital, right? And they really need cash to like fund development or something like that. So they have to sell their locked tokens in order to get the cash to fund development, right? And this could also be VCs who want to like give back returns back to their LPs. So they want to sell their locked tokens to receive capital immediately, right? So in these cases, when these entities really want liquidity and they want to sell their locked tokens, they go to something called an OTC marketplace. So OTC really stands for over the counter. And you can think about an OTC marketplace as like a private marketplace where these entities go and sell their locked tokens, and you've got buyers who are interested in buying those locked tokens, right? And when these entities go and sell their locked tokens, they sell it for a very, 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 very steep discount, right? They could sell it for like 20% discount up to like 80% discounts, right? And why are they selling their locked tokens at such a big discount? It's because whoever is buying this locked token has to wait that duration, right? He has to wait like 6 months or 1 year, and only after the unlock can the person sell it or do whatever they want to do with it, right? So there is the time component that the person buying, has to stay with the tokens locked, right? And it's also that these entities really want the cash immediately. So they are willing to go and sell their locked tokens at steep discounts, right? So maybe let's take a look at an example of what this really means, all right? Let's suppose that the token X is trading in the open market at $1, all right? So it's trading at Binance and in Uniswap for $1, right? And so this VC has like millions of tokens, and those tokens have a 6-month lock, all right? So the VC would go to the OTC marketplace and sell these locked tokens for maybe 50 cents, right? So that's a 50% discount, right? The current price in the market is $1, and this VC is selling his locked tokens for 50 cents. And this is where Neutrl comes in. So Neutrl comes in and says, okay, we want to buy these tokens from you, right? These locks tokens, we want to buy it at 50 cents, which is a 50% discount of what it is trading at in the market right now, right? So Neutrl goes and buys the X token at 50 cents, right? So how would this play out? I know what you're thinking, all right? What happens maybe after 6 months, Neutrl goes and buys this for 50 cents right now, and after 6 months, the price of X kind of collapses, right? It goes to like 20 cents, right? So Neutrl is in a very bad spot. It's like in a loss, right? So this is where Neutrl does something else, all right? Immediately after kind of purchasing this token and getting into a deal with this VC to buy these locked tokens, the 6-month locked tokens for 50 cents, it goes to the perp market and shorts the X token at the current price, which is $1. All right. So this happens immediately, right? And what this short and what the second step is pretty much doing is it's creating like an insurance. It's creating a hedge, right? In case 6 months down the road, the price of X goes down to 30 cents, right? This short is making a lot of money, while this 50-cent buy is losing a little bit. And in case the token goes to like $1.20 or $1.30, this buy that it did at a discount, which is at 50 cents, is making a lot of money, while this short kind of loses a little bit of money. So let's look at the 3 scenarios that could play out when Neutrl kind of gets into this position and kind of shorts the tokens right after it gets into the position, all right? So the first scenario is when 6 months down the road, the price of token X is trading at $1. So it's trading at $1 right now. 6 months down the road, it's still trading at $1. So it's pretty much sideways over this 6 months, right? So let's look at a quick price chart, all right? Let's suppose this is $1, this is 50 cents. So Neutrl went and bought the tokens at a discount at 50 cents, right? And it also opened a short position at the current price, right? All right, so 6 months down the road, the price kind of just goes sideways and goes back to $1, all right? So what happens right now? What's the profit or what's the loss here, all right? So this tokens that it bought at a discount is in massive profit, right? They pretty much made 50 cents from this trade alone, right? Plus 50 cents. And the short is not winning or losing. It's kind of stable, right? It's not, it hasn't made a profit or a loss, right? So the net scenario here is that Neutrl would end up making 50 cents given that the price kind of stays at $1 6 months down the road. So this pretty much is the profit for Neutrl. All right, so let's look at the second scenario where the price of X 6 months down the road goes down, right? So maybe the price of X after 6 months, it's maybe 20 cents. All right, what happens then? Again, a price chart. Let's suppose this is $1, this is 50 cents, and this is 20 cents, right? So Neutrl bought the tokens at a discount at 50 cents. And it also opened a short position at the current price at $1, all right? So the price over 6 months have gone down. And it's now at 20 cents, right? So what's the profit? What's the loss? All right. So the short that Neutrl purchased, the second step, right, is making a lot of money. It shorted it at $1 and it's right now 20 cents. So it's made 80 cents from the short. And it's discounted buy at 50 cents is making a little bit of loss, right? So it's gone from 50 cents to 20 cents. So it's a 30-cent loss. So net, Neutrl is still making money. Neutrl has just made 50 cents from this trade, right? So this is the profit. All right, let's look at the third and final scenario where 6 months down the road, the token X is trading above. It's gone up. It's gone to like $1.20, right? 120. So what happens in this scenario? So let's consider this as $1 and this as 50 cents. All right, and it's gone up to $1.20, all right? So Neutrl bought the position here, discounted position, Neutrl bought a short here, and then from this price, it's gone up over 6 months, right? So the 50 cents buy that Neutrl did, the discounted buy, is making a lot of money here. It's basically made 70 cents in profit. And the short that it opened at $1 is making a loss, right? It's made a loss of 20 cents, minus 20 cents. All right, so net, what is the profit here? Neutrl just made 50 cents from this trade. So these three scenarios show that regardless of whether the price of X goes sideways or goes down or goes up, Neutrl is making 50 cents from this trade. So the reason this entire strategy is so powerful is that as Neutrl buys tokens at a discount, those discounts become the profit, right? Discounts become the profit as long as you are able to hedge your position, right? For in this case, the token was trading at $1 and Neutrl was able to get a 50% discount, right? And thus, it's made 50 cents profit across all three scenarios. Imagine that was a 60% discount, then Neutrl would have made 60 cents across all these scenarios. And so the high level takeaway really here for you is that the discount is the profit. And once Neutrl gets into a deal with these entities and is able to get these tokens, these locked tokens at a discount and is able to hedge it with a short, that becomes unrealized profit immediately. And it just has to wait for these tokens to unlock and then it's able to realize the profit. So the profit is baked in the minute Neutrl is able to buy the tokens at a discount. And why I find this strategy really cool is that across all three scenarios, and regardless of where we are in terms of the market condition, Neutrl is able to generate really good yield. And it doesn't need to care about if we are in a bear market or anything like that, right? As long as it's able to buy tokens at a discount, it's making a profit. And that's what's so cool about this OTC arbitrage. So this is high-level overview of how Neutrl works and how this OTC arbitrage kind of works. I hope you guys understood it. And if you made it this far, thank you so much for watching and I'll see you in the next one.